Welcome to our exploration of how mergers and acquisitions, or M&A, are shaping the future of business. In today's fast-paced world, companies are constantly seeking new ways to grow, innovate, and stay ahead of the competition. M&A has emerged as a powerful strategy, enabling businesses to combine strengths, enter new markets, and accelerate their transformation. In this video, we'll break down the essentials of M&A, highlight its impact, and uncover why it's a game-changer for organizations worldwide. Let's dive into the dynamic world of M&A and see how it's redefining the business landscape. M&A stands for mergers and acquisitions. A merger is when two companies combine to form a new entity, while an acquisition is when one company takes over another. Both strategies aim to create value, whether by expanding market reach, acquiring new technologies, or improving operational efficiency. M&A can be complex, involving financial, legal, and cultural considerations, but when executed well, it can unlock tremendous growth opportunities. Understanding the basics of M&A is the first step in appreciating its role in shaping the future of business. Companies pursue M&A for several reasons. Some want to enter new markets quickly, others aim to acquire innovative technologies, and many seek to eliminate competition or achieve economies of scale. M&A can also help companies diversify their product lines or services, reducing risk and increasing resilience. By joining forces, businesses can leverage each other's strengths and resources, creating a more competitive and agile organization. The motivations behind M&A are as diverse as the companies themselves, but the ultimate goal is growth and long-term success. There are several types of M&A deals, each with its own purpose and structure. Horizontal mergers involve companies in the same industry, often competitors, joining forces. Vertical mergers combine companies at different stages of the supply chain. Conglomerate mergers bring together businesses from unrelated industries. Each type of deal offers unique advantages and challenges, and the choice depends on the strategic goals of the companies involved. Understanding these types helps clarify how M&A can be tailored to different business needs. The M&A process typically involves several key steps. It starts with identifying potential targets or partners, followed by due diligence to assess financial, legal, and operational aspects. Next comes negotiation, where terms are agreed upon, and finally integration, where the companies combine their operations. Each stage requires careful planning and execution to ensure a successful outcome. The process can be lengthy and complex, but with the right strategy and team, it can deliver significant value. Finding the right M&A opportunity is crucial. Companies often look for targets that complement their strengths or fill gaps in their capabilities. This could mean acquiring a competitor, a company with innovative technology, or a business in a new market. Strategic fit is essential, as the right match can lead to greater synergy and value creation. Companies use market research, financial analysis, and industry insights to identify the best opportunities for M&A. Due diligence is a critical stage in the M&A process. It involves a thorough investigation of the target company's finances, operations, legal standing, and culture. The goal is to uncover any potential risks or issues that could affect the deal's success. This step helps buyers make informed decisions and negotiate better terms. Effective due diligence can prevent costly mistakes and ensure that the merger or acquisition delivers the expected value. Negotiation is where the terms of the M&A deal are set. Both sides discuss price, structure, and conditions to reach a mutually beneficial agreement. Deal structuring involves deciding how the transaction will be financed, whether through cash, stock, or a combination. It also covers governance, management roles, and integration plans. Successful negotiation and deal structuring lay the foundation for a smooth transition and long-term success. Integration is often the most challenging part of M&A. It involves combining people, processes, and systems from both companies. Cultural differences, conflicting priorities, and communication gaps can create obstacles. Successful integration requires clear leadership, open communication, and a well-defined plan. Companies that manage integration well can realize the full benefits of the deal and create a stronger, more unified organization. Cultural integration is a key factor in M&A success. When two companies come together, their values, work styles, and traditions may differ. Addressing these differences early helps build trust and cooperation. Leaders must communicate openly, involve employees in the process, and create a shared vision for the future. A strong, unified culture can drive engagement and performance, making the new organization more resilient and innovative. M&A can accelerate technology adoption and innovation. By acquiring companies with advanced technologies or unique expertise, organizations can enhance their capabilities and stay ahead of industry trends. This is especially important in sectors like tech, healthcare, and finance, where innovation drives growth. M&A enables companies to access new tools, talent, and intellectual property, fueling their transformation and future success. M&A is a powerful tool for global expansion. By merging with or acquiring companies in other countries, businesses can quickly enter new markets and reach more customers. This strategy helps overcome barriers to entry, such as regulations or local competition. Global M&A also brings diverse perspectives and ideas, making the organization more adaptable and innovative in a rapidly changing world. M&A can deliver significant financial benefits. Companies may achieve cost savings through economies of scale, increase revenue by cross-selling products, or improve profitability by streamlining operations. Successful deals can boost shareholder value and provide resources for further investment. However, it's important to carefully assess the financial risks and ensure that the deal creates real, sustainable value. While M&A offers many opportunities, it also comes with risks. Deals can fail due to poor integration, cultural clashes, or overestimating synergies. Financial losses, employee turnover, and reputational damage are potential pitfalls. To minimize risks, companies must conduct thorough due diligence, plan carefully, and remain flexible throughout the process. Learning from past mistakes is key to future success. Let's look at a real-world example of successful M&A. When Disney acquired Pixar, the deal combined Disney's storytelling tradition with Pixar's cutting-edge animation technology. This partnership led to blockbuster films and revitalized Disney's animation business. The success was driven by shared vision, complementary strengths, and effective integration. This case shows how M&A can create lasting value when executed thoughtfully. Not all M&A deals go as planned. The merger of AOL and Time Warner is often cited as a cautionary tale. Despite high expectations, the companies struggled with cultural differences and strategic misalignment. The deal ultimately failed to deliver the promised value, highlighting the importance of thorough planning and cultural integration. Learning from such cases helps companies avoid similar pitfalls in the future. Strong leadership is essential for M&A success. Leaders set the vision, communicate the strategy, and guide the organization through change. They must inspire trust, manage uncertainty, and make tough decisions. Effective leaders involve employees, address concerns, and keep everyone focused on the shared goals. Leadership can make the difference between a smooth transition and a troubled merger. Employees are at the heart of any M&A. Engaging them early and often is critical for success. Open communication, clear expectations, and opportunities for involvement help reduce uncertainty and build support. Recognizing and addressing employee concerns fosters trust and commitment. When employees feel valued and included, they're more likely to embrace change and contribute to the new organization's success. Future of M&A is shaped by emerging trends. Digital transformation, sustainability, and globalization are driving new types of deals. Companies are increasingly using M&A to acquire digital capabilities, enter green markets, and expand internationally. The rise of private equity and venture capital is also influencing deal structures. Staying ahead of these trends is essential for companies looking to shape the future through M&A. M&A is more than just a financial transaction. It's a catalyst for business transformation. By combining resources, capabilities, and cultures, companies can reinvent themselves and adapt to changing markets. M&A enables organizations to pursue new strategies, innovate faster, and create lasting value. As the business world evolves, M&A will continue to be a key tool for shaping the future. Summary: M&A is a powerful force in shaping the future of business. From driving growth and innovation to enabling global expansion and transformation, its impact is far-reaching. While challenges exist, careful planning, strong leadership, and a focus on culture can turn M&A into a source of lasting value. As companies look to the future, those who master M&A will be well-positioned to lead and thrive in an ever-changing world.